much for the kind introduction, David. Yes, so I'm Pari Sastry. I'm an assistant professor at Columbia, and today I'm going to be talking about trends and risks in US property and casualty insurance. So there's going to be three parts of my talk. I'm first going to talk a little bit about what I think is the problem in insurance, and I'll be very precise about what I mean by that. And then I'll tell you a little bit about how we can expect insurers' risk management to change and what that might mean for you as real estate developers or as lenders that are working in this space. And I'll also talk a little bit about how I think government intervention and policy is going to evolve in light of what we're seeing in states like California and Florida. And then lastly, I'll talk a little bit about what I think moving forward are future risks that we should be worried about, and we're already starting to see kind of show up in a few places. So just to set the stage, academics have been worried about climate change for a long time, but in the last 5 years, we're also starting to see insurance companies playing a really public role in talking about the concerns that they have with rising losses. So we see companies like Munich Re, Swiss Re, Gallagher Re, State Farm, Allstate, they're all putting out these reports now about how they're really concerned about what climate change means for their business and to the extent to which they can operate profitably. So these are not sort of institutions that are known to catastrophize or to exaggerate. So I'm just bringing this up because, this is people who are on the ground are saying that they're very concerned about what they're seeing. So what is keeping them up at night? What is so concerning? It's something along these lines. There's one version of this chart. You've probably seen a different version of this chart. The last 5 consecutive years have experienced more than $100 billion in losses. That has not happened in the past. It's unprecedented levels of losses. And if you look at sort of what Swiss Re thinks is driving this loss, I have a decomposition on the right-hand side. You have 8% annual growth in losses since 2008, which is a really high level of losses. So if you decompose what's driving this rise in losses, a big component is coming from changing inflation, rising construction costs, climate change, other kinds of risks related to changes in the legal environment. But the biggest risk by far, the biggest driver by far of rising losses is a continual building and development in high-risk areas. That's what Swiss Re is calling economic growth, urbanization, and spatial expansion. So what do I mean by that? So this is a chart from Redfin on the left. If you look at the share of the US housing stock in high fire risk areas, that's what's plotted over time. In 1900, about 8% of the US housing stock was in a high fire risk area. Now we have 55% of the US housing stock is in high fire risk areas. The continual building and development in high-risk areas is a huge contributor to the rising losses that we're seeing over time. We also see rising population growth in the highest risk zip codes. So if you compare the high-risk zip codes to the low-risk zip codes, or the medium-risk zip codes to the low-risk zip codes, you see that we have unprecedented population growth in the high-risk zip codes. So more and more Americans are building and moving to the riskiest areas of the country. And even if we didn't have climate change, even if we didn't have inflation, if we had nothing else, that alone would lead to rising insured losses because of the fact that we're building in risky areas. So what are insurers worried about? As more and more Americans are moving to risky areas, in theory, even that shouldn't sort of pose a problem. You live in a risky area, I charge you a higher insurance premium, we're sort of okay. The problem is that we have insurance regulation, which varies at the state level, that prevents insurers from raising premiums. So there are some states that are called high-friction states. These are states where insurance companies have to submit a request to the regulator if they want to change premiums or if they want to change their pricing model. In California, until last month, they were not even allowed to use forward-looking catastrophe models in their pricing of risk. So what ends up happening if you don't allow insurers to adjust premiums as risks go up? What you have is a disconnect between premiums and risk. So on the left, I have a chart from a paper, an academic paper on this, Osan and Tenekejevia, where they show how premiums adjust with expected losses. In what we call high-friction states, you see that there's no relationship between premiums and expected losses. But in high-friction states, there is a strong relationship, and in fact, it goes up by 1. So what does that mean? That means that insurance companies are raising premiums in low-friction states where they're allowed to raise premiums to offset the excess losses that they're having in high-friction states. This is creating a disconnect between risk and premiums, and it's posing a really big issue for insurance companies to remain profitable in states where they cannot adjust prices. And what's interesting, perhaps unexpected, is that you may have thought sort of the regulation of insurance may correlate with the partisan environment of the state, like blue states have more regulation, for example. In reality, that's not the case. We see California, Colorado, and Texas, so a very blue, a purple, and a very red state, all similarly regulating insurance and preventing them from raising premiums. So it's not the case that this is just a blue state issue, as may have been previously thought. This is an issue that spans kind of political affiliations across the country, but it's a really big problem for insurance companies because if they cannot raise premiums, what are they going to do? They're going to cancel your policy and they're going to exit. And that's exactly what we're seeing on the ground. So just to show you the perspective from the insurer side, in these high-friction states where you can't raise premiums, for every dollar of premium that they collect, they're paying out more than $1 in claims. So if you do this persistently, what that means is that you're going to go insolvent. And so the average, what's called the combined loss ratio, this is the ratio of losses to premiums, the average combined loss ratio in these high-friction states is 1. That's for the past 5 years. If you did this exact graph for California, it will be $1.26. So what that means is for every dollar of insurance they're writing in California, they're paying out $1.26 in claims. So insurers are losing money in these high-friction states. But if you look at these low-friction states where they can adjust premiums, insurers are very profitable. You see that their average loss ratio is closer to 80 or 85%. So you see this big discrepancy across states in how insurers are making money. And this has actually had a very big effect in the market for insurance. If you look on the right, what we've seen is actually insurers have been going insolvent. So in Florida, over the last few years, I've plotted the net losses of 2 types of insurance companies. The first is what S&P called the Florida domestic market. These are single-state Florida insurance companies that don't operate nationally. And if you look at them, they've experienced severe losses over the last 5 years, and 15 of them have gone insolvent since 2009. There's another group that are called PUPs in Florida. These are corporate subsidiaries of national insurers. So Allstate has a Florida-specific entity called Castle Indemnity. Those guys have mostly been doing okay. So what's the difference between these 2 types of insurance companies? The blue line guys, they operate in risky areas, they respect the pricing regulation of the regulator, and after hurricane events, they just go insolvent. So you think you're paying for insurance, you think that you're covered because you're buying this policy, but in the end, they're likely to be severely exposed, and in a bad scenario of the world, they declare insolvency. Whereas a company like Allstate or State Farm that operates nationally has reputational risks and is not going to be as willing to just go insolvent. As a result, they exit the state. So what we're seeing is a growth of these very fragile single-state insurers like the Florida domestics, and we're seeing the exit of the higher quality traditional insurers like Allstate and State Farm from the highest risk states. So that's what I call the problem. We have a problem with risks not matching premiums, and that's leading to large-scale exit and insurer insolvency. So how are insurers reacting to this, and what's going to be the role of the government? So there are a few ways that insurance companies can deal with rising risks and rising development in high-risk areas. The first is in a world where they're allowed to adjust premiums, they would raise premiums. But in a world where they can't adjust premiums, they're going to exit. So what is exit going to look like? It's going to look like a policy cancellation. So insurers only offer 1-year policies. They have the option to cancel your policy every year. And what we're seeing is that's exactly what they're doing. So they can cancel your policy, they can restrict new underwriting, and they can actually develop different corporate structures. So the national insurance companies no longer operate in states like Florida and California. they've set up what are called ring-fenced corporate entities. These are subsidiaries that operate only in Florida or only in California, which they can liquidate if that particular subsidiary experiences excess losses, so that the losses in Florida and California don't spill over to the other lines of business of the company. So that's something that we're seeing, the rise of these PUPs, or corporate subsidiaries. We're also going to see insurance companies trying to promote resiliency and mitigation in building and development. It's in their interest to reduce risks because of the fact that they are unable to adjust prices. So they may start putting more conditions and terms on offering policies. For example, if you're in a windy state, a lot of times an insurance company will say that they will not insure you unless you replace the roof. This is the kind of conditions that they may start putting on policies at a wider scale if these types of trends continue. We also might see kind of new types of reinsurance products or catastrophe bond products emerging for insurers to diversify risks in other ways. Finally, we just may have a lot of insurers going insolvent, ones that are not doing a prudent job of managing their risks, and we're already starting to see that. State Farm's California subsidiary has told the regulator that if they're not allowed to raise premiums, they're going to go insolvent. Lastly, we have surplus lines. These are non-admitted insurers that can operate in a state. They're much riskier than regular insurers because they're not subject to the same set of regulations, but they are able to operate in a higher risk way. So these are all of the types of changes we might see in the insurance industry as they endogenously respond to the rising risks environment and the inability to adjust prices. And just an example of this, on the right, I've plotted cancellation rates in Florida for traditional insurers. So these are your multi-state national insurers like State Farm or Allstate. And if you see, you can look at how they're canceling policies across the state. Their cancellation rates are increasing with climate risks. So they're really pulling back from the highest climate risk counties of Florida. And they're canceling about 10 to 15% of their policies annually. So this is an average cancellation rate over the last decade. We're expecting to see much of these similar trends continue to go forward as risks continue to rise. So what does this mean for policy? There are a lot of ways in which policies can move. Because insurance is regulated at the state level, you won't necessarily see a nationally coordinated set of plans. It's more likely that each state will be trying out different approaches to see what works for the state. One thing that we'll definitely see, though, is state expansion and taxpayer bailouts. So right now, there are these markets called the residual markets. If you're unable to get private insurance, you're always able to get insurance through the state. So California has what's called the California Fair Plan. Florida has what's called Florida Citizens. These are state-run insurance companies that will insure you if you cannot get private insurance. But ultimately, these state-run insurance companies are backed in some way by the taxpayer. So that's sort of one way in which we'll continue to see state takeover of insurance markets and more taxpayer exposures to these types of risks. Guarantee funds are these state-level funds that pay out if an insurer goes insolvent. Those guarantee funds are also backed by taxpayers as well as by the other insurers that operate in the state. So that's another way in which we may see expanded state presence in insurance markets. Lastly, of course, we have disaster aid. This is not at the state level. This is more at the federal level. We may see expansions in disaster aid moving forward. And just to give you an example of the state fair plan, I've plotted on the right the number of policies that are backed by the California Fair Plan. So we've seen a growth in both the number of policies and the policy coverage provided. And we're in Florida, there was one point where the Florida Citizens residual market was the largest insurer in Florida. So these trends are likely only to get more important over time. On the other hand, we may see regulators be more open to insurance companies adjusting prices. This is what happened in Florida. There was a lot of pressure on Florida to let insurance companies raise premiums because they were threatening to exit. And that's also what we're seeing in California right now. So you may see that state regulators are more willing to let insurance companies raise prices. That's something else you may see in policy. And this right now is kind of The ground zero for this is Florida and California, but it's also starting to be an issue in places like Louisiana, Iowa, Ohio, because of tornadoes. You may also see governments trying to reduce risks by investing in resiliency or promoting resiliency or adopting zoning regulations about where building can happen. If the biggest driver of losses is new building and new development in high-risk areas, a natural way to offset that is by preventing new development and new building in high-risk areas, or forcing new building and new development in high-risk areas to be built in a different way. There's a lot of reports coming out of the Pacific Palisades with the recent LA fires that much of those developments were made with wood. This is the kind of thing that makes the house extra exposed to fire risk, and the kind of thing that maybe regulators will be less likely to permit moving forward. Oh, this is much bigger, sorry. Sorry, so this slide is just an aside. Insurance is not the only source of mispricing that we have in financial markets. We also have a flood insurance product which is provided nationally that is also widely thought to be underpriced. And we're also likely to see changes in flood insurance pricing moving forward because that program has created persistent losses over time. We also have the government presence in mortgage markets through Fannie Mae and Freddie Mac. These mortgages are not allowed to price spatial risks. What that means is that the fees that Fannie and Freddie charge don't vary by location. Because they charge the same fee by location, doesn't matter if you're in a high fire risk zone or if you're in a low risk zone, this is an implicit subsidy through the mortgage market for living in high risk areas. So there are a lot of, if the problem continues to get worse and we see more and more pressure on taxpayers to support property damage and finance property damage in high-risk areas, we may start to see changes in policy in the residual markets, in the flood insurance program, and by Fannie Mae and Freddie Mac. And I just wanted to make one point. A lot of people ask me, Hurricane Katrina was a really bad storm. Why should I be worried about climate change because I lived through Katrina and I was fine, or nothing happened to mortgages or whatever. There's a big difference between markets now and markets in 2005. If you look at where people lived, even though Katrina was a much more intense storm than Hurricane Irma, which hit Florida in 2017, it actually did not have that big of an effect on the mortgage market. Mortgage defaults after Katrina were actually comparatively low. And the biggest reason for that was there weren't as many mortgages in New Orleans. We've had tremendous population growth in Tampa, in Florida, in Miami, in these places that are really high risk. So Hurricane Irma, which was only a Category 3 storm, caused far more losses than Hurricane Katrina, which was a Category 4 storm. So this is just to say the past is not necessarily a predictor of the future. You have to take into account changes in economic conditions that lead to changes in risks. So now I'll talk a little bit about what I think are future risks and maybe more relevant for you. So the biggest thing is what we're seeing is that as premiums are going up, as risks are going up, premiums are going to have to go up. That's just insurance math. If premiums don't go up, insurers will just go insolvent. And what we're seeing is that as premiums are going up, people are responding by dropping coverage. So they're still maintaining insurance, but they're choosing to become underinsured. And so what's interesting is I have a map of insurance coverage ratios. So this is the ratio of the coverage that you've taken out as a fraction of your replacement cost. States with the most climate risk actually have some of the lowest levels of coverage. So states like Louisiana, Texas, are very high-risk states in terms of property damage losses and future projected losses, but we see that they're in the bottom quintile or the second quintile of coverage ratios. Why is that? It's because people in those states who live in the riskiest areas are often the lowest income people. They simply cannot afford to pay for insurance. So what we're seeing is a lot of people are just choosing to take on dangerously high exposures by choosing to drop coverage. So this is another trend that we're seeing. And we're also seeing, so a lot of my talk so far was focused on homeowners insurance. We're seeing similar trends in commercial P&C. So we're seeing a rise in insured losses and claims, just like we're seeing in homeowners insurance. We're also seeing very large premium increases. So this is an index produced by the commercial PC, this is a commercial PC market index, sorry, that is quoted by the NAIC. If you've looked at the last 10 years, you've seen double-digit premium increases. So this is a big issue for you as well if you're working in this space. And to the extent that risks continue to rise, you may continue to see sustained increases in premiums. And rate regulation of insurance pricing is more flexible in commercial than it is in homeowners. So there may be more, regulators may be more willing to let insurance companies adjust premiums in commercial than they are in homeowners. We're also seeing rising rates of underinsurance in commercial P&C. So one of the big issues that this rating agency, Kroll, has identified is that replacement costs are often updated only every 3 to 5 years, and construction costs can change dramatically year to year. And so a lot of companies may be underinsured and not know it. And Kroll estimates that nearly 90% of commercial properties are underinsured. And they think it's because of this timing of how people update replacement costs. So I'm less concerned about this because I think sophisticated financial actors would know to be insured, and so this is likely something that will change as premiums continue to rise and this becomes more salient. But it is an issue where we're seeing rising rates of underinsurance even in commercial P&C. So I want to take a second to kind of put everything together and talk about what I think are the big picture issues. When it comes to climate risk, it shouldn't be that you have a person on your team that has to worry about climate risk. The whole point of insurance is that that's an entity that exists to assess risks, including climate risk, and they charge you a premium that incorporates their belief about risks. And so once you have your insurance premium, once your lender gives you a rate, that is already supposed to incorporate these risks. What's happening is that we have a disconnect between risks and premiums, primarily due to the regulatory environment that these companies operate in and the political need to keep premiums affordable and low. And as a result of that, the premium that you get is not actually necessarily a signal of the risk of building or developing a particular area. And so what this means is that you may think you have insurance, you may have thought, the lender may have thought you've gotten insurance, but it could be that 3 years out or 5 years out, that insurance company chooses to cancel your policy, or that insurance company ends up going insolvent because of a large risk event. So this is the kind of thing that I wanted to mention because it's not always obvious what climate risk might mean for your business. This is my view on how you should think about these issues. It's going to affect the pricing of insurance, the availability of insurance, and the quality of insurance, which may pose a direct effect on your business decisions. Okay, thank you so much. I'd look forward to any questions. Okay. Oh, yep.
Thank you. You've mentioned that some of the commercial real estate market is more flexible in increasing insurance premiums.
Mm-hmm.
But on the other hand, the commercial real estate market, some of the players are facing difficulties due to this increased insurance premiums.
Mm-hmm.
And especially with the increased interest rates, many borrowers and many lenders are facing difficulties due to these increased costs.
Mm-hmm.
So do you see certain asset classes being more influenced by these increased insurance premiums? And do you see a resolution to resolve risks from increased insurance premiums for the commercial real estate investors?
Yeah, that's a great question. I'm sorry to say this, but I don't see much relief coming on the insurance premium side, at least not over the near term. The reason I say that is if you look at the states where combined loss ratios have been highest, so this is the states where insurance companies have been losing the most amount of money, it would take very large premium increases for them to get to what would be thought of as an actuarially fair rate. And so I don't see relief coming on the premium side, although I agree with you that this will have a profound effect on development and the profitability of new building. And I don't see a way around that. So I think the biggest way forward, what we're much more likely to see, is that an insurance company will say to you, or a lender will say to you, we're only going to underwrite this if you do X. So you may sort of get some cost relief if there's other kind of construction-related resiliency investments that are made. And that would be a way to keep premiums low because the risk has been reduced, right, of that particular property. But I think insurance companies right now have not come to agreement on what exactly those resiliency investments are. Like there's some things that are kind of obvious, there's some things that are not, and it's not clear how much a new roof necessarily reduces your probability of a loss. So a lot of this is also, we're in a new world of getting these numbers that we haven't had before. Mm-hmm. Yeah. Mm-hmm.
Hi, thank you very much.
Mm-hmm.
I actually work as an actuary at an insurance company that does catastrophe modeling.
Mm-hmm. Mm-hmm.
And actually the strategy was to buy low, sell high. So in other words, they enter the market because the premiums are so high
Mm-hmm.
and they didn't have previous losses.
Mm-hmm.
So do you see any new entrants into the field? I guess
Mm-hmm.
question one.
Mm-hmm.
Question two, on the commercial side, do you see that clients choose to, or insured choose to self-insure because of that increase in premiums?
Yes, that's right. So on your first question, we are seeing new entrants. So Florida has had 8 new entrants in the last few years. They've taken on a bit of a different corporate structure. They're called reciprocals. They're like the old mutuals. And in terms of where they operate, they actually are kind of filling the gaps in the high climate risk areas. So I think they are kind of doing the strategy that you talked about. What I'm not sure about is whether they'll be around in an adverse event. What I mean by that is I'm not sure how diversified they are and how much the reinsurance contracts that they have in place will cover them in the event of a large-scale hurricane. But we are seeing new entrants, and that is promising for Florida. So that is something I wanted to mention. On the second point, we are seeing some of the very large real estate groups kind of developing their own insurance strategies. So like insuring in-house and using cat bonds to diversify risks. I don't know, have only been looking into this very recently, but I think Blackstone does this, Apollo does this. So we're more likely to see some of this sort of capital market-based insurance if we think that that is going to be more available and priced appropriately, because if a P&C is not going to be adjusting. Yeah, great. Mm-hmm. Mm-hmm. The New York regulatory environment in terms of insurance. New York is surprisingly not a high-friction state. You might think it's one of the most heavily regulated states given the zoning and housing market. It is what we call a medium-friction state, so it's going to be more open to insurers raising premiums relative to a state like California, at least for now. Mm-hmm.
We're going to need to wrap up.
All right. Mm-hmm. All right, thank you so much, everyone.